What's up, everybody? It's Wednesday, June 15th, Fed Day. Powell goes for it with a 75 basis point. I told you he was going to do that because Powell, what does he do? He follows whatever the market dictates. Folks, I mean, was it all worth it? Was all of this worth it? By that I mean, all this hand wringing for months now, for weeks. Oh, what's the Fed going to do? 50 basis points, 75 basis points. Oh my God, inflation. What's the Fed going to do? Was it all worth it? We got a 1% move in the Dow today. What, a 2.5% move in the NASDAQ, a 1.5% move in the S&P. I don't even know if today's rally will hold, and I'll get into that in a minute. Big picture, I think we're going to be looking better now that the Fed is starting QT, and I'm going to explain that in a minute too. But I really want to stay on this question for now. Like, is it all worth it? I am going to repeat what I have said so many times in the past, that monetarism, this insane, myopic, just crazy focus on monetary policy, is a kind of a mental illness. Not a kind of a mental illness. It is a mental illness. It's a psychosis. Like, you literally have the whole entire world, and certainly the financial sector and those involved in the financial sector and the profession of economics, if you even want to call it that. I mean, just so fixated on something that is so completely ridiculous, or actually so misunderstood. And that's all we hear about, and that's all that is ever spoken about. And it is, they go over it with a fine-tooth comb over and over and over again, parsing every single word, every syllable, every intimation of what, some Fed official might say. I mean, is it worth it? We had like a normal day today. You got your 75 basis points, and the lead up to that was like hysterical, because it's like, oh my God, this is going to be the worst thing. We haven't seen something like this since 1994, almost 30 years, 28 years. Oh my God, this is just going to be horrific. It's like a normal day. It was a normal day. Hardly any volatility whatsoever. And I have to step back, and frankly, to be honest with you guys, I'm sick of talking about this stuff. Right? I don't want to be like everybody else. If you go online, whatever you read or whatever you watch on YouTube is about the Fed this, the Fed that, central banks, monetary policy. What's he going to do? Is he going to raise it this much? Is he going to lower it this much? Quantitative tightening. Oh my God, liquidity. It's a sickness. It is just a sickness. Okay? Now, let's get off of that for a second, and let me just get into some of the technicalities of this, because not even really the technicalities, I should say the realities of this. So the Fed rate, what are we at? We're at, 1.5 to 175 on the Fed funds rate. It was a 75 basis point increase. And you're talking about there's $5.5 trillion in reserves in the system. So now the Fed has to pay. They raised interest on excess reserves to 1.65%. They raised the interest on the reverse repo facility to 1.55%. So they rounded off, let's call it 1.6%, which the Fed has to pay. All right, now we're getting into the fun stuff, which nobody tells you about except me. Remember, the Fed is responsible for paying interest on reserves. That was Bernanke's big idea back in 2008. Prior to 2008, Treasury paid interest on reserves, so it was never a question. But the Fed pays interest on reserves out of its earnings. We know that the Fed last year earned on basically a $6 trillion portfolio. That was its balance sheet. It earned $111 billion, of which I think 107 or 108 billion it turned over to the Treasury, as it's supposed to do every year. It's got to remit everything except what it needs to operate, and so it keeps like 3 or 4 billion for itself. So we got $5.5 trillion in reserves, which now the Fed has to pay 1.6%. That's 88 billion. It's out of its own pocket, out of its earnings. So, that goes now to the economy. Before, and so it made last year 111 billion. So we're getting really close to that threshold where it's you know, it has just about enough money to pay. You know, if they raise the rates, like I've been telling you in these videos, if they raise it one more time in July, and I think they're still looking at a 75 basis point, but you know, that could change. Even if it's a 50 basis point, that would be another 30 billion. So that would put it over, that would put it like at, you know, almost 120 billion. That's more than what the Fed earned last year. So this is very interesting now, and nobody's telling you this, that the Fed now, the money that was originally going to the Fed as a profit on its holdings, it has to now pay out into the economy. It has to pay it onto reserves. That's going to go to bank earnings, all right? It's really positive for the banks. That's going to go to bank earnings. That's going to go to, you know, just that's money that went to the Fed, which the Fed handed over to the Treasury, so that basically went into a black hole. It went nowhere, but now it's getting redirected into the economy. So it's like, if you picture my swimming pool analogy, like, okay, you got the fiscal pump flowing in, and then you had another little pump on the pool, which was the Fed, and the Fed, when they were conducting QE, right, they were sucking all that income out for itself. So you had this big pipe with the fiscal pumping in the water into the pool, right? The expanding deficit, the level of the water going up. But then you had this smaller little pipe still sucking out water for itself, and it was going into a separate pool, a separate tank, and then that tank, the water in that tank was transferred to the government's tank at the end of the year. So it was just water sucked out of the pool, right? It just went from the pool to the Fed's tank, and then from the Fed's tank it went into the government's tank. So it was literally taking out some of the water that the fiscal was pumping in. But now the flow has been turned around. All right? You got a flow 88 billion now going into the big pool. So like, what's 88 billion divided by 52? That's 1.7 billion a week. I mean, that's not too bad. Times 4 is like, you know, practically 8 billion more fiscal a month. All right? That's not bad. Nobody's telling you that, but that's exactly what's going to happen, and most of it's, you know, going to flow onto bank balance sheets, but that's going to be bank earning. That's going to accrue to bank profits, and that's the ends up factoring into bank capital, and capital, as we know, is the only real constraint on bank lending. Okay? So, like I've been telling you, this stuff, especially when they really get going on the QT, which is going to start now, but they're going like, I think the first 2 months is 47.5 billion until they ratchet it up to 95 billion. So you're reducing the, you know, those reserves, but you're adding income, interest income to the banks and to, you know, to the economy in general. 88 billion. I mean, it's a good thing. I just see that as a good thing. Now, let me talk about, I said earlier that I think today's rally might not hold in short term, and I'll tell you why. We had, I mean, you had that quarterly tax payment today, that corporate tax payment. Up until today, that means I just looked at the daily treasury statement. The last 2 days, we've seen a 40 billion drain, a 40 billion drain from taxes. We had on the 13th, there was like 20 billion drain. Wait, let me get this right. Yeah, there was like a 20 billion drain on the 13th, and yesterday, the 14th, there was like another 20 billion drain. So how do I know this? The deficit for the month of June, which peaked at like 164 billion. It was 164 billion on Friday, June 10th. It is now down to 120 billion. So 44 billion sucked out. Liquidity sucked out. And today, most likely, with the corporate tax payment, there was another 75 billion. So what's that? 120 billion is out. Now I get it why the market rallied today, because it was I think it was one of these buy the rumors, sell the news type of deals. You know, everybody was like, are they going to do 75? RL, please, they got to do 75. Please, God, they got to do 75. Otherwise, it's not going to be good. Oh, they did 75. So it was like a relief rally after Powell went 75 basis points. We rallied up. We didn't close on the highs. We closed off the highs. But I think that was just like a relief rally. And I think this liquidity drain of the last 3 days, 120 billion, I think we'll feel that over the next few days. In other words, I think the stock market's going to lose some of its buying power. It's going to lose some of its momentum. But the good news is I don't think that's going to last very long, because this tax hit, that's over. I mean, we're not dealing with another quarterly tax, or we're not dealing with taxes due until mid-September, mid-October. All right, and really mid-September is the next quarterly corporate tax payment that's due, and October you have like people on extension and stuff like that, but they had to pay. But anyway, so mid-September. So I think from now until mid-September, you know, I said this last week. I said that this week was going to be an opportunity to buy the bottom in the market. I'm thinking that's true. Now, I still think in the very short term, the next couple of days, whatever, this tax-related drain, liquidity drain, is gonna still kind of linger and have a negative effect. But then I think, you know, as regular fiscal flows resume without these big drains, you know, the swimming pool fills back up, and I think we're going to be okay until September. And by the way, that kind of follows a seasonal pattern. You got the pattern that people know this, like sell in May and go away, right? Because you got the tax drain from April tax filings. And then you get the summer rally. Why do you get the summer rally? Because the whole tax hit, the tax-related liquidity drain is over. Then the regular fiscal for the quarter, third quarter, right? You got July, August, September. That rolls out, and that's a strong quarter fiscally. You have no drains or anything like that. And you also have a quarterly interest payment in August. So July, August, and then through, you know, mid-September. You got the rest of June now, July, August, mid-September. I think you get a rally. In the big picture, I have to be honest, like I'm still a little bit concerned about, I mean, just globally with these sanctions, the sanctions on Russia. I don't see where that is going to lead to any relief anytime soon with pressures, particularly on energy commodities. I just don't see a path how that can happen. Now, I have been telling you that oil producers, at least when you look at the futures markets, they've been selling into this rally. And by the way, today we had a pullback in oil. But until they flip to the short side, you know, I just think that it's a bullish environment with these sanctions. It's a bullish environment probably for some food commodities because of, you know, the ban or the impediments to the blockages of Russian and Ukrainian wheat exports and fertilizer and this and that. I don't know. I just think these sanctions in the backdrop. Now, you know, what usually happens, markets find an equilibrium level, they stabilize, and then they start to grow again. So like this might just be an adjustment to, you know, the hit that the global economy took from the sanctions. And we're still trying to find an equilibrium here, and maybe we're close to it. But I just don't see a path where we're going to come out of this with an improving price picture for energy commodities, not with these sanctions. I mean, these sanctions are very, very disruptive to the global economy. But I'm keeping a positive outlook. I said before that, at least according to my calculations, and given the fact that the United States now is a net exporter of petroleum. And by the way, Biden's always like, oh, he's writing nasty letters to the oil companies saying, how come you reduced refinery capacity? Gasoline production is at the highest level in 9 months, okay? We're exporting our surplus. I mean, that's the easiest thing in the world for him to do. At the stroke of a pen, he could ban exports. I mean, Trump was the one who eliminated the ban and said, hey, we got energy independence, so now what are we going to do? Let's just sell it off to the foreign sector. Let them have it. That's a great idea. But Biden's sitting there like doing nothing when the easiest thing in the world for him to do would be to ban exports. We have a very high level of gasoline production right now. You know, I just checked it out. The EIA report came out today, and I did the whole breakdown on that. So he doesn't know what he's talking about. I mean, the fact is we're exporting our product. It's just like we're exporting it. It's not a question of we don't have enough refinery capacity. We do. Like I said, gasoline production is at the highest level in 9 months. All right? It's up year over year. Gasoline production is up year over year. But we're exporting the surplus. So, I mean, it doesn't take, a rocket scientist to understand that. So, I just don't see a path to much lower energy commodity prices with these sanctions. I mean, it's just, they're killing us. You know, we are the ones who are being most negatively impacted by this. It's not the Russians. I mean, we are. And you could shut Russia down in terms of its ability to earn any kind of foreign currency, whether that be dollars or euro. Completely zero. Okay? And it would have no effect whatsoever on Russia's ability to fight the war against Ukraine. They pay their soldiers in rubles. They're self-sufficient in terms of their military. They have energy to last. I mean, it's just this thing that's going around like, oh, we got to block oil so Russia can't fight. No, it doesn't. It would have zero impact on their ability to fight the war. So, I mean, I watch this stuff and I listen to this stuff and it's maddening. It really is, because we're the ones who are really getting negatively impacted by this. We're the ones who it's coming out of our pockets. Big time. Because of this. It's not Putin's price hike. Whether you like him or not, whether you hate his guts, whether you think it's him, it's the sanctions. Pure and simple. It's the sanctions. And I don't see those going away, unfortunately. So I'd still be a buyer of energy stocks. I took some profits recently just because I see these producers selling into the oil rally. But every time it pulls back, oil and energy stocks, I buy again. But again, let me just sum it up. I mean, was it all worth it today? All this anxiety and just, hand-wringing and what are they going to do? 50, 75, oh my God, it's the end of the world. And then what, you got a 1% move in the market. I mean, everything. By the way, on a side note, let me just mention that I think, and I sent out an email about this. I think this rate hike is bullish for gold. And I think the rate hike is also bearish for the U.S. dollar. But we'll see. The dollar's definitely been on a tear. And I understand that U.S. being a net exporter of petroleum is probably bullish for the dollar. So we'll see what's going to happen. But I did put on a short position, a small short position. I actually bought some yen. So we'll see what happens. Anyway, that's it for today, folks. See you tomorrow. Bye.